Be Wealthy and Smart, episode 804.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about tech companies that are going public because initial public offerings have been strong this year, even though the markets have been up and down and all over the place. There's certain technology companies that have really come out ahead and really benefited from the pandemic, and some of those are going to be going public. We have DoorDash, Roblox, Affirm, and Airbnb going public. So let's talk about what might make those companies an interesting investment now. Don't take this as investing advice, but we're just going to cover the companies that I just mentioned in this article from CNBC that was written by Ari Levy. And it says, tech companies are lining up to go public. Here's what we learned from the most recent wave of IPO filings. And it says, tech investors have plenty of reading to do over the Thanksgiving holiday in the form of IPO filings. DoorDash, Airbnb, Affirm, Roblox, and Wish all unveiled their prospectuses in the past 8 days with plans to go public before year end. They're taking advantage of a post-election rally that's lifted U.S. stock indexes near record highs and a clear demand in the public market for high-growth investments. All 5 companies serve consumers and can expect a busy holiday season in the face of surging coronavirus cases and a drastically altered economy. It's a very different slate of entrants to the market than the previous rush in September, when a number of enterprise software companies like Snowflake and Palantir made their debuts. They each have distinct narratives tied to the coronavirus. DoorDash revenue more than tripled in the third quarter as many restaurants turned to delivery as their primary source of business. Kids gaming platform Roblox reported 91% revenue growth in the most recent quarter, measured versus last year, as it benefited from school closures and more users looking for ways to stay entertained away from their friends. Affirm, which offers point-of-sale online loans for consumers buying apparel, electronics, home goods, and other items, almost doubled revenue in the latest quarter as people increasingly turn to the internet for their purchases. Wish, an online discount retail marketplace, is also benefiting from the e-commerce boom, but its third quarter growth was more muted at 33%, in part because most of its merchants are based in China and are still dealing with supply chain challenges. Airbnb is the company most hurt by the pandemic, which has flattened the travel economy, but it's found a niche in combining vacation homes with remote work and is positioning itself for an economic rebound. Here's what we learned from each company's S-1 filing listed in the order of when they were filed. First, DoorDash. Top-line revenue jumped to $879 million in the third quarter from $239 million a year earlier, spurred by order growth of 237%. For the first 9 months of the year, orders climbed to 543 million, up from 181 million in the same period last year. In terms of the bottom line, net loss narrowed to 42 million from $152 million a year ago. Through 3 quarters of 2020, DoorDash generated a positive contribution margin of 23%, compared with a negative margin last year of 32%, meaning the company is finally, on average, making money from every order. Its COVID story, DoorDash has taken advantage of its share gains in recent years. It has almost 50% control of the U.S. meal delivery market to get its brand in front of consumers at a time when they're ordering food at unprecedented rates. Americans will eventually return to eating out, and restaurants reliant on delivery will continuously look for more affordable ways to operate. As DoorDash warns in its prospectus, The circumstances that have accelerated the increase in total orders stemming from the effects of the COVID-19 pandemic may not continue in the future, and we expect the growth rate in total orders to decline in future periods. Next is Airbnb. Its top line, third quarter revenue dropped 18% from a year ago to $1.34 billion. It's a big decline with a steeper bookings drop expected in the fourth quarter because the pandemic is keeping people close to home. But people are using Airbnb for non-urban rentals and to find creative ways to work remotely, helping the company weather the crisis better than hotels, airlines, and online travel agencies. Its bottom line, Airbnb reported a net income of $219 million in the third quarter, a slight drop from a year earlier. The company cut its workforce by 25% in May and slashed its marketing budget, leading to a 75% plunge in sales and marketing costs. And its COVID story, Airbnb was poised to be the tech IPO of the year coming into 2020, sporting a $35 billion valuation with a continuing promise to transform the way consumers travel. When business came to a halt late in the first quarter, Airbnb had to turn to the debt markets, raising $2 billion in high-interest loans and cut its valuation. Potential long-term investors can look at Airbnb's ability to adapt to a new reality faster than its rivals as a reason to get in now, along with the expectation that we're not going to be locked down forever. The next company is Affirm. In terms of its top line, for the period ended September 30th, revenue jumped 98% from a year ago to $174 million. The most growth came from its merchant network, the online businesses that offer Affirm loans when items are being purchased. The company works with over 6,500 merchants, including Peloton, West Elm, and Pottery Barn, and it has a partnership with Shopify. In terms of its bottom line, Affirm's net loss in the quarter narrowed by about half from a year ago to $15.3 million. On a percentage basis, the biggest cost increase came in sales and marketing, where expenses quadrupled to $22.6 million, tied to its new relationship with Shopify. In terms of its COVID story, the number of active consumers surged to 3.9 million in the quarter from 2.4 million a year earlier. The direct-to-consumer trend that's fueling online commerce and pushing Shopify stock higher is also driving Affirm. Look no further than Peloton, which accounts for 30% of Affirm's revenue and is flourishing from the at-home boom. Peloton's revenue in the latest quarter more than tripled, and the stock is up 290% this year. Roblox is the next company, and its top line revenue in the third quarter increased 91% to $242 million. The company's gaming platform lets kids build an avatar that they can take between games and spend money on a virtual currency called Robux for premium features. Daily active users almost doubled in the period ended September from the quarter year ago to 36.2 million. A metric the company calls hours engaged more than doubled to 8.7 billion. The bottom line, net loss in the third quarter more than doubled to $48 million from a year earlier. Sales and marketing costs were flat, but there was a steep increase in developer exchange fees, which more than tripled to $81.9 million. That's the money Roblox shares with game developers when consumers spend money in their titles. Many users eventually become developers and creators, and nearly all developers and creators started as users, the company said in its prospectus. In terms of its COVID story, in addition to spending more time and money on the app because they're home, users are also hosting virtual birthday parties and other gatherings on Roblox, generating another revenue stream for the company. While Roblox has lured many more users during the pandemic who are likely to keep using the app, there simply won't be as many screen hours available when schools reopen. The next company is Wish. In terms of its top line, revenue in the third quarter rose 33% to $606 million. Wish, known for deep discounts, continues to benefit from the move to online commerce and the increased comfort that consumers have buying items from their phones. Monthly active users rose to 108 million in the first 9 months of 2020 from 81 million in the same period a year ago. In terms of its bottom line, the net loss narrowed to $99 million from $134 million due to a 13% drop in sales and marketing costs as the company shifted investment to its logistics platform. And its COVID story? Wish was particularly exposed to the early days of the pandemic because most of its merchants are based in China, where COVID-19 first started spreading. Revenue dropped in the first quarter, then picked up in the second, but the company said that merchants continue to suffer from supply chain disruptions and slow delivery times to various parts of the world. End of article. Well, the companies I'm most familiar with are DoorDash and Airbnb. And I have to say, I've talked about Airbnb on podcasts prior to this one. And I do think Airbnb is setting up a completely new trend and whole new industry for people. It's a way for people to generate income as a landlord and sort of as a hotelier, if you will. Now, many people had tremendous success using Airbnb, but I also heard that several people that had multiple homes that they were renting out on Airbnb had some financial troubles and had to let some of those properties go. So in the short term, I think Airbnb could have some difficulty, but if we look at it as a long-term investment, I think it is a massive disruptor in the space of hotels and rentals and rental property. That could be extremely profitable for a long time to come. So I would say out of all of these companies, my favorite one is Airbnb. And sometimes these IPOs can really get ahead of themselves, so you don't always have to buy right on the offering day. You can wait and see if they run up a bit and then have a stronger pullback, and maybe even in a general market decline, you can pick them up a little bit cheaper. So I would keep my eye out for any kind of a pullback that we have in the hopes that maybe you can get one or more of these companies, if they are your favorites, at a bit of a better price. But again, do your own homework and research. This is just an initial general overview to give you an idea about these 5 tech IPOs that are coming up and what we're seeing on the calendar with these new initial public offerings. Remember, too, that a lot of IPOs have lockup periods, and that means that the insiders are not able to sell their shares for a period of time. And then once that lockup period expires, they are able to sell their shares, which makes more available. And in general, anytime you have a greater supply, that tends to make it less valuable. So that can cause the price to pull back. And again, you might get a better buy on some of these companies that you're excited about. So I will post a link to this article in the show notes in case you want to take a look to it and click through to some of their regulatory filings, which are also linked in this article. So you can see all the numbers behind these companies. Just remember that IPOs are very risky, are very volatile, and they're only appropriate for a small portion of your portfolio. But do your research, check it out for yourself, and see what you think. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And if you want to see my entire wealth mentoring library, go to lindapjones.com/podcast. All of my podcasts are there versus just about a third of them are on iTunes. So you can get the full wealth mentoring library over on my website. And there's a search box there where you can put in any topic that you're wanting to know more about and easily be guided to the podcasts that talk about your topic. It's all about getting to you to financial freedom faster. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.